70% of wealth held by America's middle class is tied to their home. And what's happening right now on a near national scale is about to change everything. We are witnessing a massive shift in real estate, rental markets, and commercial debt.
The biggest real estate crash in history isn't just coming, it's already begun.
If you make mistakes in business, you pay for them.
And if you're not paying attention, you could be on the wrong side of the greatest wealth transfer in U.S. history. This isn't fear-mongering, it's cold, hard data. Rents are plummeting.
Rent prices are falling.
Rental prices are coming down around the country.
When he renewed his lease, they dropped his rent, I think like $150.
A $2.7 trillion commercial real estate debt bomb is set to explode.
A staggering $2.7 trillion in commercial real estate debt is about to hit a wall.
Empty office buildings leave commercial real estate loans sour.
Homeowners are feeling the squeeze from rising costs, from taxes to insurance to repair costs and energy bills.
Record high inflation may have people questioning whether homeownership is a good investment.
With 2021's rates, interest payments would cost around $157,000. If it were financed in 2024, the cost jumps by a lot.
And investors are getting ready to scoop up assets at historic discounts.
When the world was in financial meltdown, central banks decided that the best thing to do was cut interest rates to almost giving away free money to people.
There's a building in Manhattan owned by Blackstone that's being marketed at a roughly 50% discount on the loan.
And by the time most people realize what's happening, it's too late. Before we break it down, today's video is sponsored by Giant Mining, stock ticker BFGFF. For the last 5 years, we've been told in America we have a massive housing shortage.
We are still looking at an estimated 4.5 to 5 million homes that we are short across this country.
And that demand was far outpacing supply. We are short millions of homes, and builders and investors need to step up and build. Many of these investors thought rents would grow at 10, 15, 20% per year due to this massive supply shortage. But that was a huge lie. In Austin, Texas, rents are down 22%. In Jacksonville, Florida, rents are down 14.3%. In San Diego, rents are down 12.7%. In Denver, Colorado, rents are down 6.7%. In Memphis, Tennessee, rents are down 5.4%. In Nashville, Tennessee, rents are down 5.2%. In San Francisco, rents are down 4.5%. These aren't small declines. These are double-digit drops in some cases. And when investors buy these properties, they're generally buying them for a 4, 5, or 6% return. When rents are dropping at 4, 5, 6, 7, 8%, and taxes and insurance are skyrocketing,
if you have noticed your homeowner's insurance rates going up, you are not alone.
Property taxes on the median single-family home have risen by more than 25%, 20% increase in home insurance premiums.
Let alone borrowing costs nearly doubling inside of 2 years. Imagine the amount of pain we're walking into. As that happened, developers overbuilt luxury apartments, thinking rents will grow at 20% per year for the next several years. And now they are slashing rental rates, offering up to 3 months free rent on a 12-month annual lease just to fill apartments. And it's about to get much worse. A $2.7 trillion commercial real estate debt bomb is going to explode on top of all of these builders, investors, and real estate speculators. In the next 30 months, all of this debt needs to get refinanced. There is no alternative. That's more than 10% of all commercial property all throughout the entire country, as we sit in a $20 trillion commercial real estate market. But here's the big problem. Most of these loans were taken out pre-pandemic with 3, 4% interest rates. Today's rates are between 7 and 9%, and even higher for riskier loan products like bridge loans and short-term debt. Office and retail are facing the worst of it. In office, you're seeing many businesses reducing square footage.
There is 27.1 million square feet of empty office space in the city.
In retail, many retailers are closing down branches or going out of business entirely.
Party City, the company told corporate employees on a call today the business would be winding down operations immediately after nearly 40 years.
Dollar Tree says it is closing 600 of its Family Dollar stores.
That's happening alongside multifamily as vacancies rise and inventory explodes. Due to all the trouble, banks are now tightening lending standards to reduce their exposure to this disaster. Here's how this plays out. Investors who borrowed money at 3%, They may now have to refinance at 7 to 9% if they don't have the cash to pay off the entire property.
The average rate on the 30-year fixed mortgage today is hovering around 7%. In 2021, rates were at all-time lows.
Banks, they'll require a new appraisal. And lower property values with higher borrowing costs, higher insurance, and higher taxes means these investors will need to come up with cash to be able to remain in control of their properties, or the bank will foreclose. And today, most investors don't have that cash. So they will be forced to sell to the highest bidder or give the keys back to the lender. This is why you're going to start to see fire sales in major cities throughout America. The pandemic hotspots are likely going to be ground zero for this real estate crisis. And guess who's buying? The investors who sat on the sidelines waiting for this moment. If you're a homeowner, you might be thinking, well, I locked in a low mortgage rate, so I'm safe. Not so fast. You may have a low mortgage rate, but insurance is going up, taxes are going up, utility bills going up.
Property taxes on the median single-family home have risen by more than 25%. There's also been about a 20% increase in home insurance premiums.
Inflation for household goods and items going up, and the job market is softening.
Consumer confidence index is also down. Unemployment claims slightly up.
Inflation, people say, is still affecting them. Prices around them are still going up.
And this doesn't consider the impacts of AI and automation in the years to come. Historically, if you had a corporate job or worked for a big company, you could stay there for 10, 15, 20, or 30 years. Now, it's very rare for a company or corporation to keep an employee for 5, 6, or 7 years. That's why we could see a wave of foreclosures in the coming couple years due to all these problems facing homeowners. And when that happens, investors will be on the sidelines looking to scoop up these properties and turn them into rentals. Let's break down how big money is positioning themselves right now, and also what you can do as well. Institutional investors are quietly buying up single-family homes in many areas and selling in other areas with high insurance premiums, like South Florida.
Your tax dollars are helping Wall Street buy up single-family homes.
Massive private equity firms like Blackstone and Pradium Partners buys or builds single-family homes and then rents them out.
Hedge funds are targeting distressed multifamily properties. Billionaires like Warren Buffett investing outside of America, in Japan, for example. Others are moving into AI, farmland, gold and silver. Why? Because they know what's coming. America is facing significant headwinds due to what we've faced over the last many years. They see the consumer is struggling, middle class is struggling, and the top 10% are essentially fueling the entire US economy. The middle class is slowly getting eroded, and I believe in the next couple of years, it will no longer exist. It will be the have-yachts and the have-nots. And this is why they are preparing to buy assets for pennies on the dollar. And this is why Warren Buffett, through Berkshire Hathaway, is sitting on $334 billion in liquidity, the greatest amount of cash that Berkshire's ever held.
$325 billion. It's the largest cash pile that any company, any public company in history has ever had.
They're getting ready for bargains. History is repeating itself. The same way investors bought up homes after the 2008 Great Financial Crisis.
These people just want homes, and they go with the flow.
They're getting ready to do it again, except this time at a far greater scale. In 2009, 10, and 11, Blackstone founded Invitation Homes. They acquired 80,000 properties. And back then, they were basically the first to really do it at that big level.
Invitation Home CEO Dallas Tanner.
Approve more housing, get more housing supply. That creates some of those pressures.
Now there's so many big companies wanting to get into single-family rentals, whether it be Pretium Partners, America's Homes for Rent. There's a lot of competitors looking for these opportunities. So as this starts to unravel, these investors are going to start jumping in and buying up homes by the many thousands. So the big question is, what should you do to protect yourself? If you're a renter, do not rush to lock into a long-term lease. Rents might drop even more, and you may be able to negotiate an even better deal in the months to come. If you're a homeowner, track your monthly expenses and see if they are growing month after month or if they are flatlining. If they are growing, save more and find ways to reduce cost and increase income. And if they are flatlining, continue to save and prepare for them to increase. If they increase, you have the cash. If they don't, you have the buffer. I believe inflation, taxes, and insurance will continue to likely creep up in the coming year or two. If you're an investor, start prepping now. The opportunities that are coming will be historic, whether you have cash on hand or financing on hand to take advantage of these deals. In just 45 days, President Donald Trump has made it clear. America first means energy first. His administration has already imposed tariffs on aluminum, steel, and he promised copper is next. On February 14th, Executive Order 14213 was issued by the National Energy Dominance Council, emphasized that copper was a critical resource for energy infrastructure, defense, and economic security. Why does this matter? Because the U.S. produces just 1.2 million tons of copper, but relies heavily on imports. Meanwhile, China consumes 57% of the world's copper supply, creating a major supply chain risk. The U.S. Geological Survey has classified copper as a strategic mineral, highlighting its essential roles in military applications, renewable energy, and AI-driven industries. This shift in policy could benefit U.S.-based copper producers, and one company is at the center of it all, is Giant Mining, stock ticker BFGFF. The sponsor of today's video. Giant Mining owns the Majuba Hill copper, silver, gold project in Nevada, a past-producing mine in one of the world's top mining jurisdictions. The company recently hit its best ever drill results and is now fully funded for its 2025 drilling program. The global copper supply crisis is deepening. BHP and Rio Tinto warn of massive shortages. Goldman Sachs forecasts copper to hit $15,000 per ton by 2025. BMI predicts a widening supply deficit, further driving prices up. Despite this, Giant Mining stock is down 90% from its peak, but has already doubled since Trump's re-election. This video is sponsored by Giant Mining, but don't just take my word for it. Check out the details with the link below and decide for yourself. If you're looking to build wealth, pay attention to where the smart money is focused. AI, distressed real estate, whether it be farmland, whether it be multifamily, single-family homes, office, retail, there's going to be a lot of opportunity across all these different sectors. And some of these, like office or retail, many would say, why would you buy there with AI and what's happening? There's going to be major bargains. And these smart and savvy investors are going to be looking at everything with an open mind. Because make no mistake, this will be the greatest wealth transfer in American history, far greater than 2008. What do you think? Do you think this will be greater than 2008, 9, and 10? You start to look at where the consumer is, household debt, credit card debt levels. People are financing groceries. The entire job market is softening radically quarter after quarter. We're seeing significant change. And the only way that I see this shaking out is the rich will get richer. If you want to position yourself to win and stay up to date on what's happening inside of the US economy, like and subscribe, and you'll receive more updates on what I'm doing and what other big trends are inside of this economy. I think we're going to see this monumental period the next 36 months to create generational wealth. And I'll keep you up to date on exactly what's happening.